Good morning, everyone. It is October 29th, approximately 10 a.m. Eastern, whenever we're doing this. But it takes a little while to get it out. A lot of volatility in physical markets and precious metal markets. We've seen the price really run down on both gold and silver in huge gaps the last couple trading days, which would have been into last week as well as the opening of this week. And then we've seen this morning, looks like both metals have bounced, definitely silver to over $1. We've been talking about the expectation on price with James, our market analyst at SD Bullion, and trying to really set people's expectations on, yes, there is a bull run up. What do those bull run ups usually look like in terms of range bound tops, range bound bottoms? I'm not the biggest subscriber to just looking at charts necessarily, but there's some people whose their entire livelihood in our industry is evaluating charts and making trades based off charts. So there's certainly merit in it. So we're going to look into it because it's going to tell us something. So we're going to get into it today. James, how you doing? What are you seeing?
Cole, thanks for having me. It's good to see you. So yeah, we've obviously had some price volatility, and nominally it looks large because the numbers have gotten larger, right? I mean, 54.50 was our recent top and nominal price, and we're what? We're getting near 48 roughly spot today.
Yeah.
So I understand the sentiment. A lot of people maybe came in and bought when silver got beyond 50 and got beyond its old nominal record price highs. But it is to be expected generally where it does do that, especially with silver, because it's a little bit more volatile than say gold. It will not only it'll break through it, but then it'll go back and retest and go down. And we're going to look at some of the ideas about how far it could retest and maybe for how long and those types of things. But ultimately, the situation is such that silver is going to run. It's just a matter of how long will this take. And in a bull market, generally, the silver spot price is going to be going up over time. That's the definition of a bull market. But it doesn't mean it goes up every week, week in, week out, like clockwork. It does have gyrations. It does have consolidations. It does have digestion moments. And this seems to be one of those digestion moments because, to be honest, I mean, precious metals all year have led the way. They've been the top four places: platinum, palladium, gold, and silver have all been really, really great. And so for it to be consolidating, this last quarter of the year, that's fine. That actually gives me the feeling that next year will be great as well. If we consolidate for a while this quarter, great. That sets up 2026 well.
Yeah,
So
it's a really good point. It's kind of like whenever anything grows, a business, a 15-year-old kid, you want it to grow sustainably. You want it to do it at its own pace in a way that allows it to kind of get its feet underneath it. And so, yeah, some pullback and some cooling is really healthy, and it points to this is more of a legitimate bull run opportunity than there's something else at play that's just making prices just slingshot. Because while that's what we saw, that's not expected to obviously continue. It certainly can't. So right now we're looking at silver's pulled back roughly 10% from the highs, and gold isn't quite there, but it's knocking on the door of roughly a 10% correction from where it was trading. We've had lease rates been a huge topic of conversation. Those have started to kind of solve themselves a little bit as we outlined how they could. In short, metals being moved over to London in the long run. Is it enough? And does that create a different problem? It likely does create a different problem in the long run. Is it enough? Well, we'll see. But at one point, I was told this past weekend there was rumors of over nearly 150 tons of silver crossing the Atlantic airborne. So that's how those banks are going to make their money. So they're going to make sure to find a way to do it. But let's go back to kind of the macro, and when we're talking about price levels for the near term, you're seeing support bound ranges at certain levels, support levels, and what are you really looking at? What matters, and how are you looking to evaluate moving averages? Because you've talked a lot about that.
sure, I'm going to share my screen so you can see.
Yeah.
So this is just this year to date roughly for gold, and obviously it's been a great year. Running from 2,600 ish now to just under 4,000 in one year is pretty impressive. And you can see kind of a two-step here, right? It's a one step to about the 3,300 consolidation line, and then
Hmm.
up toward 4,300. So it wouldn't surprise me to see some consolidation here. And it wouldn't surprise me either to see, like see this move right here where it does this and it does a jigsaw pattern. You could have a situation where it goes like this and jigsaws down to 38,
Sure.
you know? So that would be, that's to me, that's healthy. That's fine. What you want to see is this kind of this coiling pattern. And when it coils like that, it builds energy and boom, explosion. You do that again, boom, explosion. And all those banks who are talking about $5,000-6,000 gold next year, and these are conservative consultancies like
Yep.
Focus. I mean, they're out there saying $5,000 gold expected, $60 silver expected. I mean, that's the conservative mantra. And you have, I think the LB had a recent consortium over, and there was a whole bunch of registered attendees who were saying the price is roughly in that ballpark next year. And this is establishment folks. These are the people who've been underpricing gold and silver every time, especially this past year. That they had ridiculous low forecasts, and it just blew them away this year. And so now they're finally getting a little more bullish. I still think they're a little bit too conservative, but hey, we'll see next
Let
year.
me pause you real quick just to drive that point home. The LBMA is the effective governing body in London that accredits the market participants, really looks at supply chain to uh, basically get rid of any sort of unethically sourced gold and things like that, and kind of governs a lot of the things, the referee, if you will. And yeah, they're having their major conference. Actually, it's about to wrap up, but it's in Japan. We're not there because we're trying to run the business here and do what we can to do
There's a lot
that.
of work to do.
It'd be fun to go, be
Yeah.
for a week and just talk about stuff, but we got to do it. Anyway, but they did, as you said, they articulated that their price expectation, I believe, was north of 6,000 in 2026 for gold, which
And
I thought that's a huge.
that's the wisdom of the crowd. That's not just like
Correct.
being made just throwing up a dart. That's like hundreds of people who've been in this market for their careers.
Yeah.
The issue is some of these people have been in this market for their entire careers and never even held like a 400-ounce gold bar or even kilo bars. Like they look at
Yeah.
screens like they don't even understand like in terms of like how the market works fundamentally or physically. So well, let's move on. The
Yeah.
200-day moving average is kind of important. I always look at this because it's a lot of people who are kind of gold illiterati don't understand that the 200-day moving average can kind of get left in the dust in a bull market. You can look back at the 1970s over here. You can see how crazy at times it got over its 200-day moving average. You're talking about moves of over 60% in the first impetus, and then driving up in the mania to over 130% above the 200-day moving average. There is nothing like that in this bull market. Even if you consider the 2000 this run, I mean, 40 is your top roughly in 2007-ish. I mean, this impetus, maybe we do it. We'll see. But it's kind of stunted compared to the 1970s version in terms of the 200-day. Right now, the 200 days, $3,320 an ounce, and that's climbing. I mean, you look back in a few weeks, that'll be 3,400, that kind of thing.
Hmm.
We got the 50-day and the 100-day. I feel like these are kind of the more important numbers to kind of consider. Obviously, we've gone back and forth above 4,000, now below 4,000. Now we're back above 4,000. It may seem that we're going to have some fighting here at 4,000, and that's fine. That's pretty typical. A lot of times you want to have a fight or a battle at nominal numbers, like see the 2,000 nominal number. Is that
Yeah.
battle? I mean, look at how long that battle ran. That battle went on
Years.
for years, right? So that's like 4 years I'm charting right there that the battle went on. And so the 3,001 was pretty minimal. It kind of cut through there and it took off. And then we really only did the consolidation here. So again, 50-day, 3,800 an ounce is roughly where it's at. And the 100-day is roughly
Hmm.
3,600 an ounce. And you can see, it's obviously stretched. So we're going to have to get back and chop a little bit before we get another impetus to move higher. But that's probably happening next year. The silver side is a little bit more busy. Again, gold kind of leads this thing, and silver, when it plays catch up, it outperforms. And we're probably we are in a situation right now where gold has been performing a little bit better, and therefore the spot gold silver ratio has been climbing a little bit. Obviously, this is the 54.50 roughly, the top that we recently had. We shot down to the low of, near 45, 50. It will probably drive here for a little bit. We may go down a little bit further. We may come into this area. We'll see. I don't know. This is kind of, guesswork. A lot of technical analysis is trying to set up a situation where you get about 60% odds to your guesswork versus 40% being wrong. So it at least puts some edge in your favor. But this is just kind of what we use to get a feel or an idea as to the way things might go. So psychologically, you prepare. Position-wise, you cannot be caught offside. Those are the types of things you need to consider in terms of your planning or your thought process in the next few months. We got the 50-day moving average, the 100-day moving average. 50-day for silver is roughly 45, and the 100 days around 41. There is a little gap that kind of formed on some charts between 39 and 40. It doesn't necessarily have to be filled. It may, though. I mean, that's like in my worst case scenario, you get a situation where it violently shoots down for a second and goes below 40, and then probably fills that and then moves back up through the 40s and back to 50. Once we get beyond 50 again, and we make that move beyond 55, like if we get above 55, it's off and running probably in 2026. So we'll see how long we got to stay down here before we get above 55 and get going. You asked about a chart that like really matters to me right now. And I would say it's kind of a large chart, and it's really important chart because it literally calls out the fact that we have been, let's see, this is a, hopefully you can get it in the video, but this is literally like gold and silver price history throughout the United States history and just before the United States became a formalized nation. This is 1720 to now. And just the end of September, last month, right? You had gold sitting at 38.73 an ounce, and that was a great close. I mean, just look at where it was. It was just nubbing up against 4,000, and everybody's stoked. I mean, this is a logarithmic chart. It looks like stair step 1, stair step 2, eventually stair step 3. That's kind of the way this chart's going to go. And everybody was excited then, and now everybody's scared. It's ridiculous. It's only a month later, and now everyone's worried because we went up, and now we're testing again around these levels. And it's the same thing with silver. Here we are on the far right. 46.64 was the end of September, and everybody was stoked and excited. Maybe we'll get a run for 50. We did. We broke it. We went to 54.50, and now we're back near these spot prices about a month ago. Well, who cares? We busted through. That was like the most important thing, and now we're consolidating. Literally, the way I think of it, Cole, any silver bullion you get below 50 an ounce is long-term value stored. That's kind of the way I look at this. I don't really think in terms of gosh darn it, I bought silver and now it's a few bucks away and I'm a loser. No, I have a long-term plan. I look at this with at least a 2, 5, 10-year time frame in terms of it being a position that I'm going to keep, an aggressive position, outsized versus other asset classes that I own. So yeah, a lot of questions about like what's going on in terms of how are they filling.
Yeah, let's get into ETFs because that's been a big topic in the occupation they have of the ounces that are on exchanges and things like that. So let's dive in here. What are we looking at?
So this is Nick Lard's chart. He does this work. It's a little bit larger, but we're looking at the biggest ones. And this top portion right here is really, it consolidates the COMEX registered and eligible piles. The registered pile is really what matters. It's the metal that you can actually pull from the COMEX. The eligible pile is metal that's within the system, but it's not up for delivery. It's not up for being pulled. So really, when we focus on the COMEX, we need to keep an eye on the registered pile. And of late, that has been going down. You have a 4-week change of 27 million, outflow of ounces. And my hunch is almost all of it's going over toward London and or places to fill the lease rate, stop gaps. You have a big change between eligible, like moving into registered. That's been happening as well. And then obviously the combined totals of that, it's kind of misleading. Really, 27 million is the number that you need to keep in mind. And the other one that's important here is the ETFs are literally like a unsecured ETF like SLV. It's literally like how would I describe it? You're the product if you own the thing. You get to pay for the pleasure of allowing the commercial banks to run around and arbitrage the fund for their benefit, and you get to pay the privilege of owning nothing and being happy. And that's essentially it. You get price risk for owning SLV, but literally you're involved in literally an unsecured ETF that allows them to pull metal occasionally and arbitrage it for themselves and not for you. So essentially you see 13, 14 million ounces pulled from that ETF. That's basically the APs who are, borrowing shares and then pulling the metals out in order to, fill this stock gap. So you have about 14 million ounces that got yanked in the last 4 weeks. And that's
Yeah,
definitely,
I'm gonna drive that home. 14 million ounces is something that's physically backed, where those certificates were redeemed for physical on a short-term basis and by insiders, and then they use that physical metal to go arbitrage the difference between London and New York and capture a profit. So yeah, if you're sitting there buying or holding and you see that the people, buying and holding with you are doing this with the the asset or the ETF, uh, not a great feeling.
yeah, I mean, like a few years back, Jeff Curry of Goldman Sachs, back when he was head of Goldman Sachs, blurted out on CNBC, the shorts are the ETFs. So he's just literally saying that, like, look, think about we have the custodian of the ETF literally out there making markets in opaque markets and using what they're custodian of as their edge to like gain even more in terms of profit, et cetera. So my suggestion to you, stay away from SLV. That is not a place you want to sit. That's a place for the great taking. I would stay far away. The only ETF really, when people talk about it in the industry, anyone who has any common sense, they'll suggest PSLV. That's a pretty good, respectable precious metals closed end fund. They've had inflows of about 4.1 million ounces. It's very rare that you see metal fall out of that closed loop ETF, and they literally go out and buy the 1,000 ounce bars that they're supposed to, according to their terms and agreements. Let's see, you have India, which is the other major one. This is really what set off, I think, the squeeze essentially in October.
Hmm.
And we'll probably go into that in just a minute. I want to show you a little bit more, do a little bit deeper dive on India, just so people can understand the mechanics behind why this all occurred and why it'll probably continue to occur. There's your gold as well is starting to, this is registered gold. You're starting to see a collapse too in registered gold, and that's starting to come down as well. So basically, you're going to see it in all four precious metals in the COMEX and NYMEX. We've hit a top. I think we're going to start to see those registered ounces get pulled and dragged down because there's other places in the world that need those ounces, and so you're going to start to see them precipitously come down. All
Okay.
right. So the final was kind of interesting because it's fresh off, from today, information that I found that's kind of important, and it kind of gives you a concept of what has been going on. This is just looking backwards in silver, Indian demand in September. So you have nearly 400 tons that were pulled from London. That's basically like 12.8 million ounces. And this is September. This is before the squeeze and the lease rates exploded. So you can see over here, like the spike is just gigantic right here toward the end of September. And the countries of origin, about four out of 10 tons were yanked from UK. And then they had to go and raid Switzerland, which is always one of the last places you got to go. They got a little bit of China, a little bit of Germany, and little others. So it's, obviously, and this isn't even like, this is just September, right? Like there's been much bigger bars in 2024 that were, taken down. So, if they show up and try and get like metal in this size that they used to get, it's not going to work. The UK is going to tell them, come back Q1 next year, maybe you can get some
Mhm.
silver. So I think that's probably what's happening for Indians who are, trying to get more in terms of their ETFs and or bullion imports. So this is last month, and it's still, you basically have a situation where they imported in October 20.2 million ounces. And it's probably the largest contributor to why we had a drop down in London's float and why the lease rate spiked. That's just a gigantic amount. I mean, like if you look at all the other amounts that have ever come about, this is like multi-folds of any addition to the ETPs and India. So it's a big deal.
And is this just a reflection of the Indian market, the Indian population just being more bullish on metals? Is it as simple as
Yeah,
that?
I think it's a combination of knowing that the timing is probably pretty close, and we're
Hmm.
getting near $50 an ounce US dollar price, which is kind of a key indicator. If you get beyond
Hmm.
that, you kind of want to get ahead of that trade. So I think a lot of people are thrifting out of gold and they're looking for like a momentum trade into silver and outperformance of gold. And that's not just merely on their local currency level, but that's also in global currency
Yeah,
levels. You go
clearly.
around any market and silver is just saying, I'm going to outperform gold for the coming years. Look out. And so
Yeah.
Indians are getting ahead of that.
Yeah, and as they said, kind of in their email correspondence, the general market experts that were all in the room at the LBMA conference this week, they pulled up the email. They mentioned the correlation of silver to gold. So again, whenever we're evaluating both, there's a reason we have the charts side by side. The expectation was, in their words, well over $60 per ounce for silver next year in 2026, and gold to exceed $5,000 per ounce in 2026, just to kind of bring that one to light, which I think is fascinating because you get that collection of market participants in a room, and they certainly, even if they don't know the why, they have a very good idea as to the what and what they're hearing from effectively their customers worldwide, that be it central banks, be it whoever you want, industrial users, and they're pointing towards there's no stopping this because the demand is there. Like we met with a Swiss refiner. This was in um I believe it was about a year ago, and they were you could just tell they didn't really want to get into it. But we had a series of meetings, and it was very clear that central bank demand was going to be massive, and they've been getting these big numbers, and that's over the course of the next, couple of years for them. So that's good for their business, but this demand isn't stopping, and stuff that goes into China and some of these Far East markets, that's not really eligible to necessarily come back. China doesn't really have an interest in sharing. There's a reason they're accumulating so much. But anyway, turning back to you here, what are we
Oh
looking at?
yeah, this is just like right now you're looking at 15 pallets roughly of silver. That's basically 15 tons of silver, right? And so just to give you a concept of what we're talking about in size and scale, like India basically took 26 times what you're seeing in the silver in September 2025 alone from UK, right? That's just in 1 month from the UK, 26 times what you're looking at. And then in October, combined around the world where they got their silver from for those ETFs, 41 times this just for their ETFs. All right. So you're starting to get a picture of like, dude, this is just India we're talking. The second biggest,
Hmm.
silver demanding, section of the world. Like the United States generally is first when we have investment
Hmm.
demand really popping. The United States will buy a lot more silver than virtually anywhere. So yeah, obviously India is the impetus that's pushed it, but wait till you see real capital flows from the Western world chasing silver. That's what makes it scream 60, 70, 80 to triple
Hmm.
digits as time goes along.
Yeah.
So, yeah.
Very interesting. Well, unless you have anything else, I'll kind of finish with my final little question. I didn't know if you had anything from a macro print in the next couple of weeks, CPI, jobs reports, anything from the Fed that kind of was like, hey, this has my attention. And my personal opinion is that we're at step however many of a very predictable cycle, and this has already been priced in because they already know what's going to be printed and what's going to happen. But do you have any take there?
Yeah, I mean, I'm looking at the M2 in the United States. It's already up and it's going to new highs. And it's just a matter of time before something in the system happens where the federal balance sheet probably has to
Hmm.
start going back up again. So we're heading back into an inflationary environment. And, it's not something that's being discussed enough, but, the concern of recession is out there. But and the fact is that they're creating currency at a large scale again. And that's the trajectory is up, it ain't down. Um, so
Hmm.
so that's the point. It's like the whole point is they have to divide the dollar. There's no getting out of the system, the situation we're in. We have
Hmm.
38 trillion in debt, hundreds of trillions in unfunded liabilities. There's no way in real value terms we're paying this stuff off. The way you get out of that, Jack, is generally either A, defaults, or B, devalue your currency. And over time, that's what they're going to do. It's basically negative real interest rates for as far as your eyes can see, and bond markets that underperform and stock markets that lose to gold and silver as time goes along, at least into the 2030s. That's
Yeah.
basically my thesis. And so I've been buying just the past week. I've been just picking up this and that. I still am buying
Same.
silver. So
Same. Yeah, we have a deal out right now to kind of celebrate our status as an authorized purchaser from the U.S. Mint on gold bullion, doing one gold eagle at cost per customer, which, um, you know, probably a crazy time to do it. We have a disclaimer on the site. Hey, we're experiencing some brief processing delays. Yeah, we are shipping everything, but there's just been so many people selling back, along with so many people ordering that, yeah, you get bogged down and it takes you a little bit extra time to do it. But yeah, there's still deals out there, and as we approach, this all the secondary market material is gone. There is none. So as we approach the big seasonal promotional window of Black Friday and things like that, it's going to be interesting. Drips and drabs, and then what do you want to try to just give away as cheap as you can? Well, the bottom line for people that are watching this that maybe bought in the last couple of weeks, time for panic. Do they buy the top? Like that's the question they're asking.
Yeah, no,
So
do not. The last thing you need to do is panic. I think you've obviously made your first purchase. I hope that you didn't spend all your load that your position in one chunk. I hope you're going to dollar cost average into this slowly. And so, if that is the case, obviously spot prices have pulled back. You want to probably buy right now is where the weakness compared to where we've recently been, and just kind of keep moving. That's how you do it in a bull market. You basically buy on the dips. When the price dips, that's when you buy. And then when it rips, you just sit back and watch and wait. And then if it pulls back again, that's when you buy. That's how a shrewd bullion investor basically buys. Most people who are new to the market generally like to buy when it's going up because it feels good and it gives them, this sense that they're in a rising tide. And that is what you are in, no matter what, because you're in a bullion bull market. That's the suggestion. That's what we firmly believe. But in a rising tide like that, you want to buy on the dip. That's the key. Buy on the dips, and you won't feel like you made a mistake or anything like that. I mean, in the end, this is a game of ounces. It's not really a question of, oh, is my fiat dollar, on this trade the last 2 weeks, is it underwater or above water? It's not. I'm looking out, 2, 5, 10 years. You'll be very
yeah,
happy that you made these trades. That's the
yeah.
point.